Every single investor, whether you're just starting out or you've been at this for years, we all ask the same exact question. How do you find that next monster stock before it takes off? How do you get in on the ground floor of the next big thing?
We're talking about this kind of life-changing growth. Companies like Amazon, Apple, Tesla. Well, finding these isn't about getting lucky or listening to some hot tip. It's about having a blueprint, a proven system that's been battle-tested for over 100 years, designed for one thing and one thing only, to spot these legends in the making.
So that really is the big question, isn't it? In a market with thousands and thousands of stocks, how do you cut through all that noise and zero in on the handful that have this kind of explosive potential? How do you actually spot a legend before everyone else jumps on board?
Well, the answer is a system, a blueprint. It's a 7-factor method that pulls together the absolute best of fundamental strength, technical timing, and, this is crucial, super strict risk management. It's called CANSLIM. And here it is. This is the whole engine right here. CANSLIM is an acronym, and each one of these letters stands for a critical, non-negotiable test a stock has to pass. These aren't just suggestions. They're like 7 pieces of a puzzle, and they all have to fit together perfectly. So to be crystal clear, CANSLIM isn't just a stock-picking checklist. It's a complete discipline. It's about first finding fundamentally great companies, then using their charts to time your entry perfectly, and maybe most importantly, managing your risks so that one bad trade doesn't knock you out of the game. It really is a full circle approach.
All right, so let's pop the hood on this thing and really dig into what each of these 7 letters is looking for. We're going to group them into a few key themes to make it simple.
First up, you've got the power core. That's the C and the A. C is for current quarterly earnings. We want to see a company's profit per share exploding, and I mean growing at least 25% compared to the same quarter last year. This tells us the business is firing on all cylinders right now. Then A is for annual earnings growth. This checks for a longer-term track record of success, showing the business model is solid and efficient. We're looking for a high return on equity, over 17%. These two are the absolute, non-negotiable financial foundation.
Okay, next up is what I like to call the ignition system, the N and the L. N stands for new. We need some kind of catalyst, a game-changing new product, a revolutionary new service, maybe even new management that's shaking things up. Think about what the iPhone did for Apple. And L stands for leader or laggard. This is so important. The system forces you to invest in the market leaders, the top dogs, not the cheap, beaten-down stocks you hope will make a comeback. The market rewards strength, period. So how do we find those leaders? We use a specific metric called the relative strength rating, or RS rating. The rule is simple. We only look at stocks with an RS rating of 80 or higher. That means the stock has already outperformed 80% of every other company in the market over the last year. You're literally fishing in a pond of the absolute strongest stocks out there. Now let's talk about following the smart money. S is for supply and demand. We want to see huge spikes in trading volume on days the stock price goes up. That's the footprint of big institutions, the mutual funds and hedge funds, aggressively buying shares. And that leads right into I, for institutional sponsorship. The best stocks are owned and supported by these big players. Their massive buying power is the fuel that drives those epic price moves. And finally, we have M for market direction. And honestly, this might be the most important letter of them all. Here's the hard truth. 3 out of every 4 stocks will just follow the general market trend. So the rule is simple. If the market is in a confirmed uptrend, a bull market, you can be aggressive. But if it's in a downtrend, a bear market, you protect your money, you raise cash, you wait, you just don't fight the overall market. It's a losing game. Okay, so you've used all those letters to build a watch list of elite companies. Awesome. But that's only half the battle. Now comes the million-dollar question. When, exactly, do you pull the trigger and buy? For that, we need a very specific technical signal. And here it is. This is the classic trigger. It's called the cup and handle pattern. It's basically a picture of a stock taking a healthy pause and building a base after a strong run-up. The cup part is where the big institutions are quietly accumulating shares, and that little handle is the final shakeout just before the stock is ready to launch into its next big move higher. Now, let's get into the nitty-gritty, because the details matter. A high-probability setup has specific characteristics. The cup's depth should be somewhere between 12 and 35%. Then, during the handle, the trading volume should really dry up. That's a sign that most of the selling is done.
The buy point, the big signal, is the breakout. The price has to close above the top of that handle, and it has to do it on a massive surge in volume, at least 50% above average. That volume is your proof that the big money is behind the move.
This brings us to a huge psychological hurdle. This system has you buying a stock as it's hitting new highs. It feels wrong, right? It feels scary. But as the system's creator, William O'Neill, famously said, what seems too high usually goes higher. You're not buying bargains, you're buying strength at the exact moment it's ready to accelerate. Now for what is, without a doubt, the most important part of this whole thing. Finding a great stock and a perfect entry point means absolutely nothing if you don't have the discipline to manage your risk and protect your capital. This is all about survival. This is it. The single most important rule in the entire system. You cut every single loss at 7 to 8% below what you paid for it. Period. No exceptions, no hoping it comes back. This isn't about your ego or being right about the company. It's about math. This one rule is what prevents a small, manageable mistake from turning into a devastating account-killing loss. Now, just as important as cutting your losses is having a plan for your winners. The general rule is to take profits when you're up around 20 to 25%. But if a stock is an absolute monster right out of the gate, there's an 8-week hold rule to make sure you give it enough room to run. And you never, ever risk more than 10% of your entire portfolio on a single stock. See the logic. You keep your losses tiny, and you let your winners get big. So it all boils down to the simple equation right here. You take the 7 powerful CANSLIM criteria to find the absolute best companies. You combine that with a precise technical entry point, like the cup and handle, to time your buy perfectly, and you wrap the whole thing in ironclad, disciplined risk management. Those 3 pillars together create a repeatable edge in the market. So how can you actually start doing this? Well, here's a 4-step plan. 1, screen for stocks that meet the basic criteria and build a watch list. 2, go back and study the charts of the market's biggest past winners. Burn these patterns into your brain. 3, paper trade. Practice executing buys and sells for a couple of months with no real money on the line. And only then, after you've built that discipline, do you step 4, execute with real capital, using those strict risk rules. Look, at the end of the day, you have to remember this isn't some magic formula. It is a learnable skill. The goal is not to catch every single winning stock. Nobody does that. The goal is to have a map, a process that consistently puts you in the right place at the right time. With practice and discipline, you really can train your eyes to see these patterns of success long before the rest of the crowd does. The system is all here. Now the work begins.